Hey guys, it is Julie here with JT Wealth. In today's video, we are doing an update on our dividend investing portfolio and taking a closer look at our best and worst performers. So let's get into it. All right, guys, welcome back and thank you so much for being here. Like I said, today we're giving an update on our dividend investing portfolio. Now, we have been doing this as part of a series, and if you haven't caught one of those series before, the goal of all of this is to turn $50 a week into $2,000 a month in passive income. So in today's video, we'll give you an update on our current balance and holdings and take a closer look at our top 3 performing stocks, as well as our 2 worst performing stocks. Now, you're probably wondering, how on earth are we going to turn $50 a week into $2,000 a month? Let me start off by saying this is not a get-rich-quick scheme. This is a consistent investment over 25 years in order to create a solid nest egg that you can then draw passive income from. With our calculator here, we're taking $50 every single week, which equates to a $2,600 annual contribution, and investing it for 25 years. That will give us annual dividend income of nearly $24,000 per year. And this is expecting a reasonable annual share appreciation of about 7.85% and an annual dividend increase of 0.5%. So this assumes very achievable growth rates, as well as only ever contributing that $50 per week. So if you're wanting to achieve these goals sooner, obviously you can invest a bit more aggressively and add in extra income whenever possible. The biggest key is to just have a plan and stay consistent with it, making those regular contributions and picking a group of solid dividend funds that you can just set and forget and continue to contribute to year over year. Now, just before we get into our portfolio balance and holdings, this is just your friendly reminder that if you enjoy today's video, make sure you hit that thumbs up button and leave your thoughts in the comments down below. Also, don't forget to check out some of the great links in our description as well. For my dividend investing portfolio, I use M1 Finance as I find their pie really helpful for that long-term investing. So if you're looking to start a new account, check out the referral link to get a $10 sign-up bonus. All right, now let's take a look at our M1 Finance dividend portfolio. Our current value is sitting at $1,515.51. We've seen a gain of $142.94 for a return of just over 20%. Market gain has been $124 of that, and so far we've earned $18 in dividends. And currently I hold 12 different stocks in this dividend portfolio. They include Realty Income Corp, Invesco S&P 500 High Dividend Low Volatility, Coca-Cola, AT&T, Navient Corp, AbbVie Inc., JPMorgan Chase, Cisco Systems, Walgreens Boots Alliance, Shaw Communications, 3M, and Pfizer. So like I said, we're going to take a look at our 3 best performers as well as our 2 worst performers in the portfolio. The top performers include Navient Corp at 39%, JPMorgan Chase at 26%, and Walgreens Boots Alliance at 27%. Our worst performers include Coca-Cola at -3.8% and Pfizer at -3.14%. So let's start with our very best performer, Navient. They trade under the ticker NAVI and are currently at $12.29 per share. And you can see over these last couple of months, they've had some pretty solid growth. And of course, they pay a nice dividend of 15 cents per share, and this is paid on a quarterly basis. So that works out to about a 5.35% dividend yield. Now, their last payment date was just on December 18th, so we're about a month away from hearing about the next one. Now, there are actually only 3 current analyst ratings on the Navient stock, and it comes in as a moderate buy with 2 buys and 1 hold. The average price target is $14.25, which would still be nearly a 16% upside over this next year. So obviously no complaints with their performance this far, and hopefully we see some continued growth this year. Now, our second best performer was Walgreens Boots Alliance, who's up nearly 28%. They trade under the ticker WBA and are currently at $49.27 per share, and they have seen some great growth since near the end of December and in January. Walgreens also pays their dividend quarterly, and their dividend is 46 cents per share for a yield of 3.82%. Now, our next ex-dividend date is coming up on February 18th with a payment date of March 12th. Walgreens currently has 12 analyst ratings, and the stock actually comes in as a hold, and that is based on 2 buy ratings, 9 holds, and 1 sell. The average price target is $48 per share, which would actually be a negative 2.5% downside. And if we look at our recent analyst ratings, most of those holds, and especially the sell, have a negative downside. Our 2 buy ratings have some decent upside at 11 and 29%. So definitely some more mixed reviews there from the analysts, but I do love their dividend, and I am just expecting to hold this one for a while. So I'm okay with letting this ride since it's seen great growth so far already. And our third best performer at nearly 27% growth is JPMorgan Chase. They trade under the ticker JPM and are currently at $138 per share, and their growth has been fairly steady over these last few months. Once again, we have a quarterly dividend payer with an 89 cents per share dividend for a yield of 2.66%. Now, they just paid their most recent dividend on January 31st. Now, what caught my eye with this one is that it only scores a 2 on TipRank's Smart Score. And if we take a closer look, it looks like there's been some decreased hedge fund activity, some insiders selling their shares, but what really stands out is that they have a very negative sentiment from TipRank's investors. And looking closer at that, we can see that nearly 15% of portfolios holding JPM have decreased their positions lately. So just interesting seeing the negative investor sentiment there. But the analysts have a bit more of a positive outlook on the JPM stock. And it comes in as a moderate buy with 12 buy ratings, 5 holds, and 2 sells, with an average price target of $149 for about an 8% potential upside. And that does come from some well-rated analysts all within this last month. Our highest price target there is $172 for a 24% potential upside. So personally, again, another one I will definitely continue holding on to. So those were our top 3 performers right now. But now let's take a closer look at our 2 worst performers, starting off with Pfizer. They trade under the ticker PFE and are currently at $34.89 per share. And you can see if we were looking at this back earlier in December, it probably would have been one of my better performers versus one of my worst. There was a lot of excitement around Pfizer, especially with their vaccine, and I think that's what we saw back in December. But now that the vaccine is actually out, it seems that some of that steam has cooled off. Pfizer pays a quarterly dividend of 38 cents per share for a dividend yield of 4.48%, with the next payment coming up on March 5th. And according to analysts, the Pfizer stock comes in as a hold, with just 2 buy ratings and 8 holds. The average price target is $40.10, which would be nearly a 15% potential upside. So yes, although it comes in as a hold, most of the price targets actually have some positive potential. Even the most recent hold rating, which came in just yesterday, has a $40 price target for that 14.5% potential upside. And my other worst performer is Coca-Cola. They trade under the ticker KO and are currently at $49.01 per share. And again, you can see since the end of December, they've had a steady decline. They pay a quarterly dividend of 40 cents per share for a dividend yield of 3.36%. And their last payment came out on December 15th. The Coca-Cola stock comes in as a moderate buy with 4 buy ratings and 5 holds, and an average price target of over $56 for about a 15.6% potential upside. Now, we don't have a ton of recent ratings as most of them came in about a month ago, but we do see a lot of consensus around that $55 price target for just over a 12% potential. So both of my worst performers actually still have some pretty decent outlook ahead of them and plenty room for growth. So I am not panicking just yet and looking to make any changes. Both of these companies are really solid dividend players with a lot of history behind them. So that is what I'm focused on, and more of the long-term growth versus some of these shorter-term swings. And that is really important when you're investing for the long term, to be able to ignore some of those red days, weeks, or months and focus on those longer term goals and let those stocks have a chance to ride out that volatility. I continue to invest my $50 per week spread evenly amongst all of these companies. So that is really going to help with dollar cost averaging over time, as I'm buying some of them at their peaks, some of them at their lows, but stretched over that long period, it's going to average out to a really nice cost base. So that is a quick update of our dividend investing portfolio and our goals for creating that passive income in the future. You guys know I always love hearing from you, so make sure to leave your thoughts down below in the comments. What are some of your long-term savings plans, and are you setting up regular contributions to achieve them? Keep in mind, these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Always make sure you're doing your own research and due diligence before making any investment decision. If you made it all the way to the end of today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thank you guys so much for watching. I hope you have a wonderful day, and cheers.